Good morning and welcome to a What's Up with the Market session. We're going to do market status. Haven't done this for a couple of weeks, and there's been a bit of action in the markets over the last couple of weeks. So before we do that, I have to get into this and tell you that everything we cover here today is of a general investment advice nature and not specific or personal advice. And nothing that I say today should be construed as taking personal action on with without checking with a securities advisor. Right, having said that, I can now change over into Beyond Charts and we can get into the session, starting as I always do with the Dow Jones. Now, we've had a sell-off, and I'll tell you the theme of the session in a moment, but let's just look at the price action of recent times. Now, I've got this Fibonacci line that goes back to over here, which was the trough last year in September. So a year long, or just under a year long rise up at 10 months, and now we've got this retracement, and we've been talking about a 23.6% retracement and a 38.2% retracement. And I haven't drawn the 50% retracement in on the Dow because its retracement hasn't been as deep as the other indices, as we'll see in a moment. But we've got this down channel with the black lines, and this is really what we're going to see on all the indices and to varying degrees. And I've got this support zone, this blue support zone here, which is just below the 38.2 Fibonacci retracement. And we've got this lower channel line, and the Dow has gone all the way to that lower channel line again. And so we've got a number of touch points here and is finding support because remember, this is not an exact science. So I do allow a little bit of grace of a day and up to maximum of 5 days below a support zone and similarly above a resistance zone on the upside. And that is because we do find that ranges extend a wee bit, and so we've got to allow for that. So we are hanging in, and this is the theme, hanging in by the skin of our teeth here on this uptrend, this longer term uptrend that started over a year ago now. And this retracement is serious. It's a serious one. It's a secondary bear market, if you like, in a primary bull market. We could even go, depending on what your time frames are, could even say this is a primary bear market, having had a primary bull market rise up. And in the next week or next few weeks, it's not going to be next week, I will be doing a secular bull market update where we'll look at 100 years worth of data and see where the markets are in that bigger picture time frame. So we're hanging in over here. We've got, as typically happens in bear markets, the Dow outperforms the S&P 500. That's this relative strength line at the bottom over here. So for the bullish case, let's cover the bearish case first. Bearish case is pretty simple. This support doesn't hold. We fall below it. We fall below this lower trend line. There's another support zone down over here, which is pretty close, but a little bit weaker in the touch points, a little bit not as clear as the touch points I've got on this support zone we've got here. And so that's pretty easy. And we fall all the way down to the 50% retracement and see what happens there on the Dow. So hanging in by the skin of our teeth on all the support technical indicators and patterns, if you like, on the Dow. The upside is that we move all the way up to resistance and the upper channel line and break through that and get an entry signal using our ATR breakout indicator here. And you can see there's the red signal over there indicating that this is in a sold market, if you like, using that single indicator as an indication of what's happening in the markets. So let's go down to the S&P 500. And I'm just going to change my period here to just 25 and go down to the S&P 500. S&P 500 has actually broken support for two trading days and now back into the channel, found support at this just below the 38.2 and just above the 50% retracement on the Fibonacci, and certainly hanging in by the skin of our teeth here, that support zone. found support, and volatility has risen. This is an ATR measuring volatility over a month period, 21-day period, and that has just tipped off a wee bit with the rise in price over here and has risen through over the last month and a half or so. So hanging in by the skin of our teeth on the S&P 500, and we'll have a look at some other indicators on the S&P 500 here before we have a look at the Nasdaq. So this is the cumulative new high, new low. Pretty obvious here. We got the new highs, more new lows than new highs measured over 52 weeks, and the market falling. So you'd expect to see that. So that breadth of market is bearish at the moment, and we'd want to see an uptick in then more new 52-week highs being made, and that's going to take more than a day or two, which we've just had a little bounce off our support zones. Similarly, with the cumulative advanced decline line on the S&P 500, just a little jump over here. So more stocks advanced than decline, but that's one swallow does not a summer make. But the trend is down on the advanced decline line as well, and that's to be expected with the sell-off that we've had in the S&P 500. Okay, next chart. Got a little bit of a hang here. Right, looking at the whoops, that bounced through both. Oh, a little bit of slowness on the. Hopefully, we're not doing an update or something, which typically slows down the data. Come to this in a moment. The US dollar. Right, let me just check my settings here for period. It's all data, that's why. Let's just go to 25 years. Okay, so looking at the breadth of market indicator here of the number of stocks that are above their 150-day moving average on the S&P 500, an uptick. So some did rise above their 150-day moving average. Obviously, we've got that this fall over here of the number of stocks that were above the moving average, the 150-day moving average. So breadth of market is showing weakness. We're below the 50 percentile and approaching this oversold zone down here at the 15 percentile. Above it at the moment, if it does go lower and we get below that 15 percentile, then we know that we are reaching pretty oversold zones on the breadth of market indicator. Right, this is the US dollar. Now I've got a different chart here. I'll just zoom out so we can see very quickly. I'll explain this. And this is one of the highest negative correlations that you will find in any measurement between two different market sectors, if you like, or parts of the market, or what we call intermarket analysis. And it's measuring the US dollar, that is the red and the green lines over here, to the CRB index, or we used to measure it against the continuous commodity index. CRB index looks at commodities, and we'll look at that in the raw CRB index in a moment. And what I mean by negative correlation is that when the US dollar rises, let's find a period over here. When the US dollar rises, we'll look at some more recent data. The US dollar rises, the CRB index falls, and vice versa. When the CRB index rises, the US dollar falls. And I've gone and put I haven't shown this at all in any of these What's Up with the Market sessions. Been sitting in the background in my analyses. And because there's something that's going on in more recent data that is a little bit out of kilter with what this data goes back to 1998. And I think CRB index goes back to about the early 90s or thereabouts, if I showed you more data. But this, you can see it here clearly. So here's a period, and I've put these ellipses around. There's not too many of them. 1, 2, 3, 4, where they have actually gone in the same direction at the same time. So not being a perfect science, you're not going to find 100% hit rate in anything in the markets, but we're looking for a majority of cases, if you like. We're looking for weight of evidence. And this, you will not find such a negative correlation between two intermarket relationships just about anywhere in the markets. So why we're doing this is because there is also a negative correlation between the US dollar and equities. When the US dollar gets stronger, equities tend to fall. And when the US dollar falls, the equity markets tend to rise. And the US dollar is still strengthening, which is not a good sign for stocks. It doesn't mean stocks won't go up, because there are periods where they both, when the dollar gets stronger and the equity markets get stronger. But it's a weight of evidence thing. And we're just looking to get an idea across a number of different indicators as to what is going on in the markets, and not with a view to predict. And I should say at this stage, I cover this for general market analysis reasons. This should have no effect on mechanical traders, mechanical active investors, which is what I am. And this does not go into any of my decision making that I make in the markets with respect to my portfolios where there's real money on the line. So just get back to these correlations. So the US dollar falls, CRB index rises, or the other way around. And here you have periods US dollar falls, CRB index rises, and you'll be able to get access to this analysis and pull this apart in your own time. But this negative correlation is very, very strong. So let's just come to the more recent data here. And here the periods, US dollar falling, CRB index rising. And here's a period where they both rise together. And it's happened a number of times here. If you're just looking bigger picture, you can tell with your naked eye, there's the US dollar rising, there's the CRB index rising. Now, but if you do go into little shorter periods of time over there, you will find the negative correlation still holds in shorter time frames. But just that general trend, you can see both rising there. Here, it comes to the negative correlation comes to the fore again. US dollar rising, CRB index falls. And just looking at I took all these little trend lines off over here, we're not seeing this obvious negative correlation, since about this time last year, over the last year. But if you zoom in, which I'll do over here now, so what we're looking for is a strong negative correlation. That's obvious. This isn't obvious. Here it looks like they're both kind of in sync, but going basically sideways. But if you zoom into shorter periods of time, you'll see over here that the negative correlation on shorter periods of time is still valid. I'll just get the value line up over here, and you'll see there's a period, just looking here, US dollar rises, CRB index falls. Then we get to that point, almost to a bar or two. It's not far off. But there you see the fall and the rise of the US dollar, and you see the rise and the fall of the CRB index. And here's a period where they kind of rise together most of the time. Then there's a period here where the CRB index falls and the US dollar rises. So this correlation very, very strong. So what are we looking for over here is the CRB index has got 6 commodities in it, of which oil plays, and they're equally divided. But oil has been stronger recently, which has been pushing the CRB index up. And it's not, the oil doesn't play a big enough part in the CRB index to say, well, let's just go and do this with the US dollar versus oil, because that is an intermarket relationship that you could analyze as well, which I'm not going to do today. We can leave that for another time. But what we're looking for over here is for this long-standing, obvious negative correlation to come to the fore again, one way or the other. And this is another, and because of this almost sideways movement in a year, is showing massive market indecision. That is what this is telling us. And the financial markets, where they are sitting, hanging in by the skin of their teeth, with their fingernails on the cliff, if you like, is also at the lower levels, if you like, the bottom of the channel lines, at major support zones, is showing this market indecision that is going on at the moment. And it's going to break at some stage, and we don't know which way it's going to go. So this really is saying indecision, confusion in the market. But when it does break, the longer that this indecision goes on, and it has been, the bears have been more in control over the not over the last year, but over the last 2 or 3 months. But there was a good run up, obviously, from September, October, November last year. It was a decent run up in the equity markets, but now we're feeling it again over the last 2, 3, which is a normal retracement given the run up that we had from September last year, that trough. So now we've come through September, October, the bad months. And now we're going into, everybody's looking for the Christmas rally. And I guess the message right now is that it's not obvious it's going to happen. This indecision still holds with high interest rates. And now there's wars around the world, all this sort of stuff. But the market does climb a wall of worry. And it's at times like this that really fundamental analysis, you can throw it out the window, because it does not help at all. This is a time where, and we don't want to get into predicting because we just don't know what's going to happen. And we have to subscribe to the fact that anything can happen, especially as a mechanical trader. And what we don't want to do is predict, and we don't want to fear either. But these indicators are telling us that this indecision is going to break one way or the other. It's like a coil that's getting wound up, and at some stage is going to be let go, and that let go coil is going to go either up or down, one way or the other. If it goes down, as mechanical traders, we'll get a heap of exit signals. Sure, we'll wear a bit more drawdown, but we'll then go into cash. But we also don't want to. The worst thing that can happen is if you try and predict the markets are going to fall to the downside, and you go 100% into cash, and they absolutely take off. And how many times have we seen that? In fact, I just did a little recording yesterday of what happened in 9/11 back in 2001, and we saw this in COVID as well, where very serious, high-profile market commentators were saying, it's definitely going to go to the downside. I'm into cash. Or they didn't say definitely going to go to the downside, but they certainly voted with their money and sat on the sidelines, when the market went up 20-30%. So that's just as bad as hanging in when you should have sold and riding the market the whole way down. When you go into cash and the market takes off. So we don't know what is going to happen at the moment, and this is just another indication of major indecision and hanging on by the skin of our teeth at this stage. Right, so let's just quickly get through. This is another new indicator I've brought in over here. I'll just zoom in. It's the Russel Growth Index, the Russel 1000 Growth compared to the Russel 1000 Value. So the Russell 1000 takes roughly the S&P 500, the S&P 400. That's 900 stocks, and round about the top 100 of what the S&P 600. So this is quite a broad index. The Russell indices have the 2000 and the 3000 as well, and they typically say this is the large cap, but it does take in most of the mid cap and even some small cap as well. And you can see here, excuse me, that even though the growth index is falling, the relative strength relative to the value is still rising. So what that is saying is that growth stocks are still outperforming value stocks. And I know the value analysts for some time now, for years, maybe 5 or 6 years, maybe even longer, have been saying, value's going to come, growth's not going to happen, value's going to come. And it's getting a bit long in the tooth at the moment, but it has just some more short-term evidence that growth is still the growth, even though the raw index, the base index is falling, is still outperforming the value, meaning value is falling by more than growth. And this is the S&P 500 I've got down the bottom over here. But the key indicator here is this Ciroc indicator that I put on the ratio, the relative strength comparative line. That's the ratio line over there. You can see this is still trending up with growth outperforming value. So what you would typically see in a really negative bear market is that value should come to the fore, at least for shorter periods of time. The consumer discretionary is falling, and it's just at the last couple of weeks over here, it started tipping over relative to the consumer staple. But this trend this whole way through over here, even with this falling section over here on the raw consumer discretionary index, and I'm using the SPDR, the XLY SPDR here, a sector ETF to indicate what's happening in consumer discretionary, the Ciroc is still holding up over here. So in a really negative environment, we would see consumer staple really come to the fore, and we'd see the Ciroc falling. We haven't seen that yet. I'll just get rid of that value line so it doesn't confuse stuff. Right, and on to the put call ratio. This is still a bear market indicator where I've got the Ciroc here on the year long, the 252-day simple moving average of puts versus calls. And just a little bit, and it's been a bit whippy, but you can see this trend is just slightly starting to go down here. And I know there are some market indicators that have market commentators and callers and stock pickers that have started buying. So they're trying to pick the bottom, and this is why you're seeing this little line over here, the last few over here, more calls being bought than puts, which are bottom pickers. People are trying to pick the bottom of the market over here, and they've tried to do this the whole way along. Every time you see a down, this used to be dots, I've now made it a line chart. Every time there's a dip over here, that's calls outperforming, buying of calls out, more calls being bought than puts being bought, and that's typically bearish. And we're seeing it again, bottom pickers out there. In my view, it's still too early to try and pick bottoms, but if you're following a mechanical system, then you're buying stocks as your signals come up. Right, the 10-year Treasury note still rising. And this is a market that people put a lot of emphasis on, that has a very low correlation to, not a very, but a low correlation to equities. But there's the 10-year, there's the yields versus the market, and you can see yields rising, market falling. And when this Ciroc is rising, it means there's the relative strength of yields outperforming the market, and that is a bearish indicator, and is certainly what you'd expect for the type of market we've had. VIX index, fear index, has certainly risen off its low levels over here into this kind of zone that is only a third off the bottom. So just relatively, where's my bottom line over here? Let's just go. So you can see there's the bottom part of the real low zone, high zone, and that's the extreme zone over there. So we're about a third of the way off the bottom. So still not near extreme levels on the fear index. Right, onto the Nasdaq Composite Index. Okay, what we have here, this middle line is a relative strength to the S&P 500, and then I've got a smooth index trending indicator on the relative strength line. So just to see what has the upper hand in the relative strength between the S&P 500 and the Nasdaq. And I've got this on a medium, medium to longer term setting, 55-34 setting. So this is not, it's not a sensitive measurement I've got on this. I'm looking more medium to longer term, many months. And even though the Nasdaq is falling, you can see the relative strength line is really falling slowly at a slow gradient here. Meaning it's underperforming if you look at the naked eye. The Nasdaq compared to the S&P 500. So S&P 500 outperforming the Nasdaq in that period of time. But I'm looking at the CIROC over here to get a more smooth indication of where things are at the moment. And it's pretty similar. You can see that we've had the bottom channel line over here has been transgressed and then bounced back into the channel. There's the 38.2, very similar to the S&P 500, sitting between the 38.2 and the 50% retracement of that same Fibonacci run-up from September last year. So hanging on by the skin of our teeth here. That's really what's happening, falling out of this rising channel, the red one over there, now in this primary bear market, if you like. So, and there was the sell signal back there in August, 9th of August, on using our mechanical system indicator on the Nasdaq Composite, back into the channel here. So this is where things are really in indecision mode. Is the price going to rise? It's going to bounce off this support over here, which is not one I've just put it now. I've just really just dragged it across from previous price points where it's touched, either rising into or falling down to, or is it going to go further down below the 50% Fibonacci retrace and fall through this support zone, which we can tell. And I did say, a couple of weeks ago that we're going to know pretty soon. Now we're into November. We're out of the September-October timeframe. We're hanging on by the skin of our teeth here. How is the market going to react here? Are buyers going to come in and buy these dips and have a Santa rally, or are the bears going to get in control and we're going to fall through all these support zones where we basically are right now at the moment? A 1 or 2 up days in this downtrend, that's always going to happen. So this evidence of just 2 up days now is just way too small an amount of evidence to say, hey, it's over and this is it and the dip's in. We don't know. So as mechanical traders, mechanical active investors, we just got to follow our rules, and we got to, anything can happen, but we also got to say, we don't know what's going to happen, and nor do we need to know what's going to happen in order to make money in the market. We've got to break that nexus with us fearing what may happen in the future. And sure, it may fall, in which case we get sell signals and we have a little bit more drawdown. But as I said earlier, the worst thing that can happen is this market does take off. We do have a Santa rally, and you sitting in cash watching the thing rise. So that's why we trade with a mechanical, rules-based, non-discretionary system. And we do that because we subscribe to the fact is that we are undecided and we have no idea what's going to happen. So let's get through the rest of the stuff pretty quickly. No new news over here, nothing that I can use here to say, hey, something's imminently going to change. But that's the cumulative new high, new low on the Nasdaq. And that is the cumulative advanced decline line on the Nasdaq 100 they're all following, confirming each other, no divergence there, so nothing that we can pick. And the same is with this with the breadth of market indicator. Sure, we're going to see with a couple of up days, we're going to see some stocks tipping back over their 150-day simple moving average, the stocks that make up the Nasdaq 100. So that's typical, but we're still below the 50 percentile, so more below their 150-day moving average. This is the semiconductor subgroup, and this is now confirming. We've got a sell signal here, if you like, where effectively semiconductor stocks, which are more growth than what the Russel growth index we looked at a bit earlier. This is more succinctly focused on a group of stocks that are typically would be rising in a bull market, and people would sell off in a falling market where there's more negativity. So these people have given in a bit more. We've had more weakness here, and we're way out of this channel that was rising. And it is time for me, not probably, to start putting in these a downward channel. So I'll just do parallel lines, and you can see how nice and neatly that subscribes to, there we are, lots of touch points, pretty good channel line, and we're right at the bottom of that as well. So what we're looking for here is this relative strength line has been getting gradually weaker and weaker, and now we've had the CIROC tip over. So that's showing weakness and certainly risk off at the moment. The poor old All Ordinaries has fallen below its support lines. There's a support zone there. It's fallen below this channel line that I've got drawn in over here, and it's way below these lines over here going sideways. And I did describe this. I've been reminded by a few people as a dog's breakfast. It continues to be a dog's breakfast. So what would you do here now that it's fallen below, and there's sufficient evidence there to say it's fallen below, is you would draw another trend line over here and just look for touch points. And you can see it's pretty good trend line, a few touch points over there. And just extend that control key. And you'd look to see, and there's no other support zones over here that I could put in going back, maybe a weak one round about that level, and then see if there's not a weak, I'd put a dotted rectangle in there. But weakness there. And even though it's matching the S&P 500 here, you can see it's probably just a slight down gradient over there as well. So not certainly sellers in control in the All Ordinaries, and not looking so good over there. Last one to look at here before we look at some commodities, and we look at the CRB Index, which I did the US dollar relative strength comparison to a few moments ago, is that the share price of Australia is still very much in a downtrend, but at a very strong support zone over here. And it hasn't spent too much time below the 60 cents over the last, when does that go back to? 1998, over the last 25 years. So if it does go below there, it's not auguring that well for Australia. We do need to see US dollars and other currencies coming in to buy our market, but also to get into our stocks, and which represent various sectors. So now we'll quickly go into have a look at the commodities. Get through this. This is the CRB Index. Nice rise. I'm not going to do a Fibonacci on that yet because that's still a pretty shallow one. The Fibonacci in control really is this big one here, this massive downtrend there. And until we get above there, sure, we could do a shorter term Fibonacci, but it's still below 23.6. So it's been a pretty shallow retracement on this. I'm talking about this retracement here of that run up in the red channel line, and is remaining above, got to the 50 percentile, which is this major downtrend over here from back in 2007, 2005, 6 was that run up, and resistance here. There's the 50 percentile of that major downtrend. So that's a major, that's a major inflection point, and big long-term trends, and it's finding some resistance over here, outperforming the S&P 500. This is telling us down the bottom here. So commodities outperforming equities there. Right, gold, interesting, had a breakout. This long sideways movement that's persisted since 2020, and left that channel line in over there. Then I drew this gray channel line, and we had a clear breakout above this gray channel line over here. So we can say, and there's the outperformance of gold on equities. I'm just going to go to just very quickly I'm just going to go to show you another chart, which is a pretty important one. And I'm going to, where was it? Sorry for this, not that one. No, not that one. This is it. And I'm going to just quickly go out to all data and show you something that you got to be on the lookout for. And that the key here is that gold rises strongly when we have secular bear markets. Okay, so when was a secular bear market here? So this is going back all the way to 1978. And you can see that this was the secular bear market that went on for 13 years between these two red lines. And gold absolutely took off during that period of time. Whereas in the secular bull market we had from 1982 to the year 2000, which is basically this period over here, there's the breakout down here of the 1982, and that's where the secular bull market started in equities, went up 1,200%, all the way up to here in 2000. Gold did nothing, went sideways. And now that we've been in a secular bull market from the breakout in April 2013 and this rise up, and I'll update my secular bull market analysis in a few weeks' time, is that gold has gone sideways in this period as well. So when this next secular bear market starts, which it's going to do, some people are saying we're already in it. One of the clear indications is going to be a breakout in gold. And it's likely, although there's no dead certs and anything to do with the markets, is that the sideways movement that we've seen here during the secular bull market is we're going to see another rise in gold, a strong rise in gold, while equities go into their long-term secular bear market environment. So we're not in that at the moment. There's not enough evidence to say we are, and I'll give update and reasons to that, as I said, in a few weeks. But everybody's saying gold is going to take off. And they've been saying that for this whole period of time that we've been in a secular bull market in equities. But that's only going to happen, really, or there's a very high probability it's only going to happen when the secular bear market is in for equities. And that's not evident at the moment. Right, silver, nothing really to look at there. It's just comparison. Copper, let's look at Dr. Copper, the bellwether, still in a downtrend. Nothing to report here that's changed. It's got a breakout out of this downward channel. And you can see underperforming gold as well as copper. We want to see, in a really good market for small cap stocks, we have copper outperforming gold. But that's not happening at the moment. Right, Brent crude has been an upward channel broken through sideways, a bit of a symmetrical triangle forming over here, which is a continuation pattern. And there it is, outperforming stocks. So oil, and that's a little bit of what we saw in the US dollar at the moment. This is pouring into the CRB index. Getting close to the end here. This is the breakout that's occurred in the Bitcoin. Pretty classic. There's the buy signal. I use the Ciroc 26.9 to get these sort of shortish to medium term moves in Bitcoin, and they're certainly rising. The Ciroc no sell signal yet, and had a sideways a bit in a breakout. So we've broken out in that downward channel. We've also broken above. Whoops, lots of analysis on there. Above this support resistance zone over here. So what would we expect? A bit of a retracement. This might be it. I don't know. If it's a very strong market, then that could be. That's a very short-term symmetrical triangle that's set up over there. It might still come down and retest that resistance zone. But if it doesn't and it breaks out of this little tiny short-term symmetrical triangle, it's going to go up and test 40,000 again. That's what the price action is telling us on Bitcoin. And the Ethereum hasn't broken out of the equivalent down channel that you saw on Bitcoin. And look for that breakout. Certainly, there is an entry signal over here on the then I'll just quickly zoom in on the Ciroc 26.9, where the blue line crossed above the green line down there. But and short-term short, but a little bit also a symmetrical triangle form there. But we want to see the breakout out of that channel in Ethereum to follow Bitcoin up in its breakout. Uranium still the commodity that to talk about. It's in this channel that has got a bit steeper and is continuing to rise. Bit of resistance here, and with these weekly charts that we've got on these line charts, there are not a lot of peaks and troughs. So there's one, two, maybe three. So, and this is a resistance zone. That's why I've got the dotted line there to show weak resistance, but this is still a rising commodity price. And iron ore broke out this channel, got up to resistance, fell down to the channel line, has had some higher highs and higher lows, testing over here. For iron ore to run again, it really does need to get above this 125, I think it is roundabout zone, and above that to get it going up to the sorts of levels we saw up there. And lastly, thermal coal looks like it's found a bit of a base. There's a bit more evidence of a base here than on the way down. Got up to resistance, very weak resistance, a few touch points, come back down. And for this to continue up, we need to see it go and challenge this resistance line again. So that's it. Certainly from a theme perspective on this fortnightly session that I do is Nasdaq, Dow Jones, and the S&P 500 hanging in by the skin of our teeth, and massive indecision. As I showed you, really the primary chart, I put all that around, although all the others are confirming it as well, was the US dollar to CRB index ratio and the negative correlation there, and showing the indecision that's happened over the last year there. Right, some questions. Let's go back from Dietmar. Interesting. Major market indecision is not accompanied by high volatility right now. Great point. The volatility on the S&P 500, here it is right here, is sitting at 1.33%, which is still low. And where does it get to? Well, this is where it got to in COVID. It got way above the 3.5% line, but even started rising just when the fall happened so sharply going into COVID. That we got into the twos pretty quickly, and that takes some time to dissipate. And if we go back to, 2008, we get to sevens but we also pretty early on got to above 2 and even up to 2.5, when you wouldn't have known what was coming. So it's still pretty low, and it does take some time to get there. So that's a great point. So sitting at 1.33 at the moment, which is relatively still pretty low for volatility. Rob is saying, thanks, Gary. Do you have a chart showing how often we have seen a Santa rally in past years? No, I don't have one at hand. And it is one of those stats. Everybody says September, October, the worst months, and statistically they are. If you go back a long period of time and look at the data, but there are September and Octobers that we've had rallies, and so it doesn't mean just because I haven't done the stats on that it doesn't mean because we have Santa rallies that there's going to be one. There's just no dead certs, and anything can happen, as per Mark Douglas's fundamental truth number 1. He was saying, Gary, is there a strong correlation between gold and Bitcoin, or is there not enough data yet? There probably is enough data to start drawing some conclusions, Steve, and it's one I haven't done, or have I? Maybe I have. Let's go and have a look. I don't have it on if I did it anyway, I probably have it on the Bitcoin chart. I'll do that. That's an interesting one. I'll do that for the next one. Thanks for that. John saying, thanks. Can you quickly comment on gold versus silver? I certainly can. And I do typically do that from the silver chart. And so at the moment, okay, so what have I got here? I've got the gold. So there's the gold, silver, 21. Okay, this is what I do. So I haven't looked at this for a while, but so I've drawn so typically what, and the theory here is, I'll just update that across to there, is that red line, if you like, is a bit of a median. It's an eyeball median of when this blue line, which is the ratio, it's a relative strength. It's just one divided by the other. It's a relative strength comparison. When the blue line is above this horizontal red line over here, is that silver is outperforming gold. And that's typically the theory is that, and it is certainly, there are instances when this happens, but not all the time. There's no 100% proof, if you like, theorems that this happens in. But when gold has a run, that typically leads silver, and then silver catches up. And the idea is to be in silver when just after gold's gone, because you're going to get that lag, if you like. So gold goes and you miss that, there's a chance to get into silver because it lags gold, and you can get the big bucks there. So what people look for is what is silver doing relative to gold? And I've got that red line as a median proxy. It's not a dead cert, but it gives an indication over a period of time as to where silver is relative to gold. And you can see here that this is showing, and I'll just put a trend line on here, that effectively silver has been, that's out. So when this is falling, silver's underperforming gold and gold's outperforming silver. And at the moment, where would we put it? I'd probably, let's just do this. Let's just join the dots and see what it says. And you've got a symmetrical triangle forming over here and coming to a little bit of an apex. And so don't know which way that's going to go. And you can certainly apply technical analysis concepts to this, is that the trend is down, the ratio is down, the underperformance of silver to gold is down, bit of a symmetrical triangle, so indecision happening here. And this is just really a ratio of what these two prices are doing relative to each other, is that this typically would see silver getting weaker. But if gold does go, the odds are that silver will follow, and that breakout might happen to the upside of that. So I'm not seeing, just purely from my subjective trained eye and technical analysis, you'd be trying to bottom pick, if you like, if you got into silver now thinking that you're going to get something out of it. I'm not seeing enough technical evidence there. Let's just do another trend line. So that's the silver price. So a little bit of you can do a parallel line there. And it certainly is, you're seeing that underperformance with gold rising and having a bit of a breakout. You're not seeing that in the silver price at the moment. So that's the relative on the gold versus silver. Okay. And that was Dietmar. Dietmar asked the same question. That Steve, or does Steve? No, sorry. No, Dietmar asked that. There we go. Right. No other questions? Thanks for your attendance and time. Hopefully that's given you an idea of where things are in the market. Indecision, massive indecision, probably typical of high interest rate environment. Kind of, it's the Trump that's hanging over, the Trump card that's hanging over there. Go, don't play your hand yet. And the rubber's still got some way to go. And we'll let the price action tell us, as we always do. So thank you for your time, and we'll get this recording out, and I'll be back in a fortnight to see what excitement the markets gave us, either in the up or the down direction. But as always, I wish you consistent and objective investing.